Silicon Valley Bank went under today. And when I say under, I mean under. Like their stock is completely frozen. Regulators have moved in. FDIC insurance has kicked in. Those regulators are going to make people whole if they had $250,000 or less, because FDIC insurance insures up to $250,000. Any depositors larger than that may receive some money when assets are liquidated. And then there's going to be creditors that may receive some money when assets are liquidated. And then it's probably the equity shareholders at the very back of the line that are going to get anything, if anything, once everything's been liquidated. But this company is now dead. So what exactly happened at Silicon Valley Bank today? Well, between 2019 and 2021, Silicon Valley Bank tripled the amount of deposits they had. And that you would think is a good thing, because deposits, or it's money coming in the door, it feels like that would be a good thing. However, with banks, deposits are liabilities because, number one, they have to pay interest on those deposits. So they got to figure out how to pay interest on that. And number two, there's a lot of costs involved in holding money in a bank. They have to pay their workers. They have to, pay for the property where the bank's at, et cetera. Just all the costs that go into running a business go into holding those deposits. And so they have all these deposits that they need to earn interest on. And when they can't do it in a reasonable fashion, they'll often buy safe investments like treasury securities. However, they bought treasury securities when interest rates were really low. So as of today, and we'll talk all the details, but as of today, they held a bunch of long-term, long-duration government treasury securities, which had a yield of 1.79%, which is not very good. And that's because they were buying them when interest rates were very low. When interest rates rose, yields on those treasuries rose as well. So they just bought them at a really bad time. But no big deal, right? They're making interest. They can pay interest on their depositors. It's all hunky-dory, except for when interest rates rise. Because when interest rates rise, the value of older bonds that have lower paying yields is going to decrease to reflect the fact that people are demanding a higher yield now. If the bond decreases in value and is paying the same amount of money, it's going to be a higher percentage of the value of that bond. The yield goes up. So people are selling these long-term treasury securities to reflect the fact that there are now higher yielding treasury securities on the market. And those obviously continually went up as interest rates continually increased. That means that on the balance sheet, there was a loss. They had a mark-to-market loss. And it's not a loss if you don't sell, but they had an unrealized loss on all those treasury securities that they were holding that matured in like 10 years. But it's not that big of a deal unless people start pulling deposits, because if people start pulling deposits out, then they start having to liquidate those treasury securities at a loss, and that's not a good thing. So mark to market's one thing where it's just like an unrealized loss, but when you're all of a sudden forced to liquidate these investments to make depositors whole when they want to withdraw their funds at a loss, then things can start becoming a problem, and it can snowball when people catch a whiff that there's something fishy going on. So typically banks would loan out deposits as like just loans or mortgages or whatever, but there was so much money flowing in. Like I said earlier, the deposits tripled between 2019 and 2021. There's so much money flowing in that there's not really a reasonable place to put it. So they were putting it in these long-term duration treasury securities. However, the interest rates rose, causing the value of those treasury securities to decrease. No big deal, as long as depositors don't want their money. And these depositors are big depositors because they're these venture capitalists who are trying to store their money somewhere in the meantime until money is cheap again. And so on that point, money has become less cheap. It's not as easy to borrow money. As the Federal Reserve rose interest rates, these venture capitalists had less of an appetite for risk. And so fundraising became more expensive. Startups became more expensive because money became more expensive with these higher interest rates. And so they started pulling their deposits to cover their liquidity needs, which all of a sudden becomes a problem for Silicon Valley Bank. And I would like to take this moment to thank the sponsor of this video, which is ExpressVPN. Did you know that Netflix hides certain content based on where you're located, like Rick and Morty? Oh, geez, Rick, that really sucks. How do we get around that? With ExpressVPN, all you have to do is click a button, and it'll change your location and unlock content for you to watch, like Rick and Morty. Plus, it hides your internet traffic from your internet service provider and other people who may want to grab and sell your data, which is great, and they do this by rerouting all of your internet traffic through their 100% encrypted servers. It does what incognito mode pretends to do, which is hides your internet traffic and keeps your information safe. And why should you choose them? It's because they are literally the fastest VPN provider out there. Click the link in the description, sign up, and get 3 months free. Thank you, ExpressVPN, for sponsoring this video. And so as these venture capitalists and depositors started pulling money out of the bank was forced to liquidate their assets, which are these treasury securities, at a loss because the interest rates have risen, which causes bond prices to decrease, especially when they're long-term duration bonds. They're going to decrease significantly when, say, interest rates increase by 1%. And this started to snowball as people started pulling deposits out, rather large deposits, forcing Silicon Valley Bank to liquidate their assets, these long-term duration maturity bonds, at a significant loss. Just today, I believe, they sold a bunch of bonds that had a yield of 1.79%, which is terrible right now. Even I think the 10-year treasury security is around 4%. So they bought it when interest rates were super low. They sold a bunch of those for a $1.2 billion loss. And so now they have a problem because people are doing a classic bank run, because they don't know if this bank is going to have the funds to cover the deposits if they withdraw their money. And it becomes this mind game of, should I just be cool and let it ride, or should I go to the bank before the other guy does, which is just a classic bank run. And then, kind of in a panic, they announced a stock sale to raise capital so that depositors could be made whole and they could actually withdraw the funds if they needed to. But that spooked the stock market, and there was a 60% decline in the value of the company's stock, as people were worried that the stock would dilute further as they would need to raise more capital. And of course, it doesn't look good on a company if there's a bank run. And suddenly, the Silicon Valley Bank is scrambling for funding that it cannot get, and regulators step in and just bitch slap them, slam the doors shut, and say you're done. And that's why if you go and look at their stock right now, it's frozen. It's not halted. It's done. The company's over. Like I said, people will be made whole up to $250,000 because pretty much every bank is FDIC insured, which means you are insured by the government up to $250,000. And regulators have taken over to make those people made whole to that extent. And then, of course, they'll sell all the assets they have and try to make as many people made whole as possible, with the shareholders being at the back of the line to get whatever pennies are left over, likely pretty much zero, if not actually zero. So how could Silicon Bank have avoided this problem? Well, they shouldn't have purchased long duration securities at 1.79%, because if interest rates rose, which was pretty likely from 2019 to 2021, and by 2021 interest rates were like zero. So there's a pretty good chance that interest rates are only going to go up, which is going to cause a decrease in the value of your assets. And if people want to withdraw their deposits because now cash is expensive and they need cash to meet their liquidity needs, then you're going to have to liquidate those assets at a loss as interest rates rise. And that's what happened. So it was a bad move to be buying long-term duration treasury securities, like 10 years maturities, which are very sensitive to interest rate. They have high interest rate risk. They have high duration. So they shouldn't have done that. They should have at least done shorter term maturities, but they did not. And as a result, today regulators took over and shut them down. And that is it for Silicon Valley Bank. And I'm sure a lot of people are really pissed off. I'm sure a lot of the depositors had quite a lot of money with Silicon Valley Bank that they'll never see again. And same with shareholders. If you look at the stock chart, you can see the market cap. I actually don't know what it is off the top of my head, but that money is basically just deleted. By deleted, I mean deleted. What am I, 12 years old playing Fortnite? It's basically gone. So there's a lot of people that got screwed over by this, in that it was really based on that one move, which was buying these long-term duration treasury securities, which is just like, why would you do that? Because those are more sensitive than short duration treasury securities or short maturity treasury securities. So why not buy those instead? Especially when there's a high propensity or likelihood that interest rates would be rising in the future. So there you go, ladies and gentlemen. That is how Silicon Valley Bank has found its way to the graveyard in a day.